Hello, my name is Jacqueline Gilbert, and I'm the Chief Compliance and Operations Officer here at Saxon Financial Group. Today, I have a short presentation on net unrealized appreciation, leveraging company stock, and if this is the right strategy for you. So before we get started, what is net unrealized appreciation, or NUA as we call it? Well, NUA refers to the difference between the original purchase price of your company stock, known as the cost basis, and its current market value in your 401k. So what are some of the key factors that we look at to determine if this is the right strategy for you? Well, first off is eligibility. So your plan has to allow for net unrealized appreciation. Second, it has to be a triggering event. So 59.5 is typically where most plans allow for an in-service withdrawal, or you have to be separated from service. Next, we look at cost basis, and this is really important. Cost basis is the price that you paid to purchase the share of company stock. The lower the cost basis, the more effective this strategy is. And then tax rates. So we're going to take a look at your ordinary income tax rates versus your capital gains tax rates. So let's take a moment to focus on taxes. Most people are familiar with the tax rates right over here to the left. Those are your 2025 federal income tax rates. And it shows what taxes you would pay at different levels of income. What people often aren't aware of is these tax rates right here in the middle, your capital gains tax rates. And on average, most investors pay around 15%. But take a look at this. There is also a 0% tax rate if your adjusted gross income, that's your taxable income minus your deductions, which we have your standard deductions listed over here, is below $96,700 if married, filing jointly. So why is this important? Well, looking at the brackets, it makes a lot more sense in any situation to pay long-term capital gains tax rates over ordinary income tax rates. And this is the basis of NUA. NUA allows you to treat company stock in your 401k differently from the rest of your retirement savings during a rollover. So let's take a look at how this works. We're going to look at a standard rollover to an IRA. So this is taking your non-company stock funds and your company stock funds, rolling them over into an IRA, where that allows it to grow tax deferred until you need to take a distribution. When you take that distribution, you are subject to 10 to 37% ordinary income tax rates based off of what your income is for that year. However, the NUA process actually breaks this down a little differently. So what we're going to do in the NUA process is we're going to separate your non-company stock funds, roll that into an IRA where it can grow tax deferred, and then when you need to take a distribution, you're going to pay anywhere from 10 to 37% taxes on it. But for your company stock, we're actually going to transfer in kind into a taxable account, and this is where cost basis really comes to play. So in that tax year that you do transfer your company stock out of your 401k, the cost basis is going to be subject to ordinary income taxes, while the NUA is actually subject to 0 to 20% capital gains tax rates. So let's take a look at this in number format because I think it's a little bit easier to digest. So on the left here we have the NUA strategy, and on the right we have the non-UA strategy. And for the basis of this example, this investor is in the 24% tax bracket. So the value of the company stock inside of the 401k is at $400,000. But we originally purchased this stock for $100,000. That means that we have appreciation inside of the 401k for about $300,000. So if we're going to do the NUA strategy, we transfer the company stock out of the 401k, and we're going to pay that ordinary income tax on the cost basis. So that $100,000 at a 24% tax bracket is about $24,000. Then it goes into a taxable account to be held or sold off. And if it's sold off immediately, you're going to pay a capital gains tax rate of about $45,000. So that means the total taxes that you would be spending on $300,000 of appreciation is about $69,000. However, in a non-NUA account, you would pay the 24% tax rate on the earnings that you've made. So 24% on the $400,000 equals $96,000 in taxes. So doing the NUA strategy in this example saves you about $27,000.